Let me be very direct with you right now because what is happening in the silver market is unlike anything we have seen in modern financial history. And if you are not paying attention, you are going to wake up one day and realize that the window to protect yourself has already closed. The data is screaming, the charts are confirming it, the physical market is telling you the truth, even as the paper market tries desperately to hold the illusion together. And I am going to walk you through every piece of it today because you deserve to understand what is actually going on with your money, your future, and the one asset that has survived every single collapse in the history of human civilization. Let's start at the foundation because you cannot understand silver without understanding money. And to understand money, you have to go back to Rome. The Roman denarius was originally 95% pure silver. That coin built an empire. It paid soldiers. It funded trade routes. It created civilization as the ancient world knew it. But then something happened that should sound very familiar to every single person watching today. The emperors needed more money than they had. Wars cost money. Political promises cost money. Empire maintenance cost money. So what did they do? They diluted the silver content of their coins. Slowly at first, just a little, barely noticeable, the way you never notice when someone starts turning down the heat, degree by degree. By the 3rd century AD, that denarius contained less than 5% silver. The rest was copper and cheap alloy. And within decades of that final debasement, Rome collapsed, not from outside invasion alone, from within, from a currency that no longer meant anything, from a population that could no longer trust the money in their hands. This is not ancient history. This is a blueprint. And every single fiat currency that has ever existed in the history of the world has followed that exact same blueprint. Now, fast forward to 1971. Richard Nixon closes the gold window. The United States severs the last formal link between the dollar and precious metals. In that single moment, every government on earth was liberated to print as much currency as it wanted, backed by nothing except the promise of future productivity and the force of law. And for a while, the system worked because the dollar was king, because the world needed dollars to buy oil, because the petrodollar system created artificial demand that kept the whole house of cards standing. But since 1913, since the creation of the Federal Reserve, the dollar has lost approximately 96% of its purchasing power. Not 50%, not 60%, 96 cents of every dollar you held in 1913 has been quietly, systematically, and deliberately stolen from you by inflation, by money printing, by a system designed to enrich those closest to the money spigot at the expense of everyone else. And right now, in 2025 and 2026, we are watching the acceleration of that process in real time. The U.S. national debt has surpassed $37 trillion. Interest payments on that debt alone now consume nearly 40% of all federal tax revenue. Let that sink in. Before the government spends $1 on roads, on defense, on social programs, nearly half of everything it collects in taxes goes straight to paying interest on debt it already owes. This creates what economists call a death spiral. The government borrows more to pay the interest on previous borrowing. The Federal Reserve must eventually monetize that debt, which means printing more currency, which debases the purchasing power of every dollar in your pocket, which causes foreigners to trust the dollar less, which causes them to sell their dollar holdings, which puts even more pressure on the system. Larry Fink of BlackRock, the largest asset manager on the planet, has said publicly that hard assets are one of the few places left to preserve wealth. Jeffrey Gundlach, the bond king, says deficits are out of control and the dollar is destined to decline. These are not fringe voices. These are the people who run the financial system telling you that the financial system itself is under stress. Now, here is where silver enters the conversation in a way that most people still do not fully appreciate. Because silver is not just a monetary metal, silver is not just gold's cheaper cousin. Silver is the most electrically conductive metal on the periodic table. It is irreplaceable. It is non-substitutable in the overwhelming majority of its industrial applications, and right now the world cannot get enough of it. Global industrial demand for silver surpassed 700 million ounces in 2025 for the first time in history. That is 700 million ounces consumed by solar panels, by electric vehicles, by artificial intelligence data centers, by 5G networks, by semiconductors, by medical devices, by the entire technological infrastructure of the modern world. The electrical and electronics sector alone has grown its silver consumption by 51% since 2016. Solar photovoltaic demand has quadrupled since 2015 and now represents 17% of total silver consumption, up from just 5.6% a decade ago. China alone increased its solar capacity by 45% in 2024, and the International Energy Agency projects that global solar capacity will expand by 3,200 to 4,400 gigawatts by 2030. Every single solar panel requires silver. Every single electric vehicle requires silver. Every single AI chip, every circuit board, every 5G tower, every electronic device that powers the civilization you live in requires silver. And there is no replacement. There is no synthetic substitute. There is no lab-grown alternative to the most electrically conductive metal that nature has ever produced. And yet the silver market has been in a structural supply deficit for 5 consecutive years. 5 years in a row, demand has exceeded supply. The cumulative shortfall between 2021 and 2025 totals approximately 800 million ounces. That is nearly equivalent to 1 full year of global mine production simply gone, drawn down from above-ground stockpiles, from exchange inventories, from ETF holdings, from everywhere the market could find metal to feed an insatiable industrial beast, and the mining industry cannot simply flip a switch and produce more. Here is what very few people understand about silver mining. 75 to 80% of all silver produced in the world is a byproduct of copper, zinc, and lead mining. It comes out of the ground as a secondary product, which means that even if silver prices double, even if they triple, mine operators cannot simply ramp up silver production because their operations are driven by the economics of base metals, not silver. New primary silver mines take 8 to 12 years to develop from discovery to production, and grades are declining globally. Recycling contributes roughly 180 million ounces per year, and that number has been essentially flat for years. There is no cavalry coming. There is no supply surge on the horizon that will rescue the deficit. The structural imbalance is baked in for years, possibly a decade. Now let's talk about what this means for the physical market right now, because this is where things get alarming in ways that should compel you to take action today. COMEX registered silver inventories, the metal that is actually available for delivery against futures contracts, have collapsed from approximately 346 million ounces in 2020 to roughly 82 million ounces by early 2026. That is a 75% drawdown in 5 years. In December 2025, traders demanded delivery of 46.6 million ounces of silver in just 4 trading days. To put that in context, that represents approximately 60% of all the registered silver on the COMEX in a matter of days. Silver lease rates. The cost to borrow physical silver exploded to over 100% annualized during periods of acute tightness in 2025 compared to a historical norm of 1 to 3%. When someone is willing to pay more than 100% annualized to borrow physical silver, that is not speculation. That is desperation. That is a market screaming that it cannot find metal. The London Bullion Market Association, the LBMA, the Center of Global Spot Silver Trading, saw its eligible silver stock shrink to only about 155 million ounces, while annual demand was running at 900 million to 1.2 billion ounces. The ratio of paper claims to physical metal has become so extreme that the market is beginning to crack under the pressure. And then China moved. Starting January 2026, China implemented new export restrictions on refined silver, requiring special government licenses and minimum production capacity thresholds that effectively block hundreds of smaller and mid-sized exporters who have long served as key suppliers to global industrial users. China consumed 45% of global platinum production in 2025. China increased its solar capacity by 45% in 2024. And now China is restricting silver exports, effectively telling the rest of the world this metal is ours and you cannot have it. This is not a trade policy dispute. This is a strategic resource declaration. China is saying publicly what the data has been saying privately for years. The world has entered an era of silver scarcity. And the United States government is saying the same thing. In September 2025, the U.S. Geological Survey officially designated silver as a critical mineral for the first time in history, placing it on the same list as lithium, cobalt, and rare earth elements. This is a national security designation. This is the federal government telling you that silver is strategically essential to economic and military competitiveness. That designation unlocks stockpiling authority, enhanced permitting, and potential tax incentives. It signals that the era of treating silver as just another commodity is over. Now, I want you to think about what this means for the gold to silver ratio, because this is one of the most powerful signals in the precious metals market. Historically, over centuries of monetary history, gold and silver have traded at an average ratio of approximately 60 to 1 point. That means 60 ounces of silver bought 1 ounce of gold. Today, that ratio has been running above 90 to 1. At some points in 2025, it stretched above 100 to 1. That is an historic undervaluation of silver relative to gold. When the ratio mean reverts even partially, silver outperforms gold dramatically. In the last major silver bull market, silver's rally was approximately twice the size of gold's. In the current cycle from 2024 to 2025, silver posted a 67% gain compared to gold's 52%, and as of late 2025, silver surged over 76% year to date, while gold was up only 30%. Silver is leading, silver is outperforming, and silver is still, by historical standards, deeply undervalued relative to gold. So what does a silver allocation that survives collapse actually look like? Let me be precise, because vague advice costs people money. First, you need to understand the distinction between paper silver and physical silver. OCTFs, futures contracts, digital silver accounts, pooled programs. These are all claims on silver. They are promises. They are counterparty risks. When the delivery crisis at COMEX deepens, when lease rates are 100% annualized, when 60% of all registered silver is being demanded in 4 trading days, you need to ask yourself, is your silver a piece of paper with a number on it, or is it a physical asset held in your possession, free and clear? Because in every financial collapse in history, the people who survived were the people who held the real thing. Physical silver coins, physical silver bars, silver that you can hold, that you can move, that no counterparty can rehypothecate, that no exchange can declare force majeure on. The paper market for silver is built on a fractional reserve system where less than 2% of futures contracts actually result in physical delivery. That system is showing its cracks right now in real time with data you can verify yourself. Second, your allocation size matters. Traditional financial advisors say 5 to 10% in precious metals. In normal times, in a stable monetary system, that might be fine, but we are not in normal times. We are in a monetary system where the largest asset manager on earth says hard assets are one of the few places left to preserve wealth. We are in a system where interest payments on U.S. debt consume 40% of all tax revenue. We are in a system where central banks globally have been buying more than 1,000 tons of gold per year because the people who manage sovereign wealth understand what is happening, even if they cannot say it publicly. Your silver allocation needs to be sized to actually protect you during a monetary transition, not just diversify a portfolio during a bull market. Think about your monthly expenses. Think about how long a monetary transition can last, because history shows they can last years, not weeks. Build an allocation that reflects the severity of what the data is actually telling you. Third, understand the multidimensional nature of silver's value proposition right now. This is not just a monetary debasement hedge. This is not just an inflation hedge. Silver simultaneously benefits from currency debasement, from industrial scarcity, from the green energy transition, from the AI revolution, from geopolitical fragmentation, from the de-dollarization trend, and from its official designation as a strategic critical mineral. There is no other asset on Earth that checks that many boxes simultaneously. Gold is monetary, oil is industrial, silver is both, and it is irreplaceable in both roles. The gold to silver ratio tells you it is still cheap relative to gold. The 5 consecutive supply deficits tell you the physical market is being drained. The COMEX registered inventory collapse tells you the exchange system is under stress. The 100% lease rates tell you physical delivery is becoming urgent. The China export restrictions tell you the global supply chain is fracturing, and the U.S. critical mineral designation tells you even the government understands that silver is no longer just an investment, it is a strategic asset. Every empire that has ever debased its currency has followed the same path. The Roman denarius from 95% silver to 5% silver over 2 centuries, the British pound losing its reserve currency status through debt and debasement after 2 world wars, the Weimar hyperinflation where wheelbarrows of paper were needed to buy bread. The historical record is not ambiguous. When governments borrow more than they can repay, when central banks print more money than the economy produces, when the people's trust in the system erodes, tangible assets, real assets, assets that cannot be created with a keystroke or promised away on a futures contract, those are the assets that survive. Silver has been money for 5,000 years. It has survived the fall of Rome. It has survived the collapse of the British Empire. It has survived every fiat currency experiment that has ever been tried. And it will survive whatever comes next. The question is not whether silver survives the collapse. The question is whether your allocation does.